Hello, can everybody hear me?
Yes, sir, we can hear you, sir. Thank you.
Welcome to the Pide webinar. We are going to go at it again, trying to find out how we can help Pakistan research, Pakistan policy. My name is Nadeem ul Haq. I'm going to invite my panelists. We've got Gonzalo Varela, senior economist at the World Bank, a long-time partner. Gonzalo, thank you very much for joining us again. Gonzalo is leading us in this effort to try and understand exports. We've got Ghulam Qadir from the National Tariff Commission, and we've got Ahsan Malik from the Chief Executive of the Pakistan Business Council. Ahsan Saab, Ghulam Saab, thank you very much for joining us. Let me begin. We're going to discuss export promotion schemes and see how they're working out. So to start the session, let me invite Gonzalo. Gonzalo, please, can you make your presentation so that we can take it from there?
Great, thank you so much, Nadeem, for the introduction. Let me share screen. Okay, so I will take about 25 to 30 minutes to make a presentation, then we can have a discussion. So the topic today is export promotion schemes, and in particular, two export promotion schemes that Pakistan has in place, the duty drawback of taxes and the drawback of local taxes and levies. These are essentially export promotion schemes in the sense that the schemes target a specific set of products that are going to be eligible for a rebate. And this rebate is set as a percentage of exports, as the export values FOB. And so by design, basically the percentage rate of the rebate will depend on three things. It will depend on the type of product that is exported, and then some products are eligible for 2%, some for 3%, and some for 4% rebate. The destination that is reached by the exporter. So there is a list of destinations called non-traditional destinations that de jure, so in principle, are eligible for an additional 2% rebate. And then there is another condition that has to do with the growth of exports of that exporter. So if the exporter achieves a certain rate of growth of exports with respect to the previous period, then that exporter is going to receive the full amount, and if not, it's going to receive half of that. So this, what I'm saying basically here is what the SROs that govern the way these two export promotion schemes actually say, and these SROs are the SRO 711-1 of 2018 and 142B TID also 2018, but these are long-standing schemes actually. They have been in place for many years, so these SROs of 2018 have made some changes in the way these schemes work, but the duty drawback of taxes and duty and drawback of local taxes and levies are schemes that have been in place for quite some time. The disbursements have been relatively slow, but lately they have been accelerating a little bit. So between July 1st, 2018 and June 30th, 2020, there were $225 million that were disbursed. Fiscal year 21, there was an additional 43 million, and these disbursements actually have continued happening. So the 43 million, there were additions in disbursements. However, not all firms that are in principle eligible for the incentive actually do get the incentive. So there are many of these rebates are awaiting there, and exporters have been waiting for these rebates actually to be liquidated, to be paid into their account. So just to give you a sense of that, there were about 9,000 exporters are eligible every year for receiving these rebates, but about in the last fiscal year, about 1,500 textile exporters and 985 non-textile exporters actually got the rebate. So not everyone gets it. Some are eligible, some are not eligible. But within those that are eligible, some get it and some do not get it. So they are called duty drawbacks in principle, but in practice, they are just an export promotion scheme. So basically what I'm going to discuss in this presentation is what is the objective of these schemes, not basically what the SRO says, but if one examines the targeting, so the way these schemes are targeted, so what products are selected and what products are not selected to be eligible, then can we say anything about the objective, and can we say anything about whether these schemes are conducive to growth of exports, to diversification of exports, to sophistication of exports, or to transforming the export basket of Pakistan into an export basket that is sustainable from an environmental point of view. And so let me share with you 4 main messages that the analysis that we did with my colleagues offers. The first one has to do with the growth objective. So looking at the design of these schemes, are these designs conducive to growth? So what we do find is that the schemes do target products that have revealed comparative advantage in Pakistan, right? In the case of DDT, these schemes target products that are exported by larger exporters, but the eligible products tend to face lower global demand, and the destination premia, so this list of non-traditional destinations, tend to be destinations with low potential in terms of exports. The second main message, when it comes to the diversification objective, the schemes have a very marked anti-new bias. So they are pro-incumbent, they are anti-diversification. The services sector, for example, is completely excluded from this scheme. In terms of sophistication, our analysis shows that the eligibility rates target less sophisticated products, and higher rebate rates go to the least sophisticated products that exist in the export bundle of Pakistan. When it comes to sustainability, we look at 2 things. We look at water intensity of products, and we look at energy intensity of products. And what we find is ambiguous results. So there is no evidence that the schemes target more products that are intensive in water usage. There is a little bit of evidence that there is a bias on energy intensive products. So this is basically the main messages of the analysis. Let me go a little bit more into detail. So if you want to understand which are the products that are eligible and which are not, so most of the eligible products are going to be in textiles, in footwear, in miscellaneous products and transportation sectors. On the left side, the chart shows the number of eligible products as a percentage of the total products in the sector. So you see in leather, textile and clothing and footwear where you have more. If you look at export values, basically almost 100% of exports are targeting the footwear sector, transportation, miscellaneous sectors, a little bit less in leather, textiles, animal products, and almost nothing in foodstuffs, plastic, and rubber, and very little in vegetable products. Now, the interesting thing is to look at the take-up. So as if there are exporters in this panel, many of you may know that you may say, well, actually, I export an eligible product, but I don't get DLTL or DDT, right? Actually, many firms that were in principle eligible for receiving DDT and DLTL did not receive this rebate. So if you look at data since the beginning of fiscal year 18-19, there were about 10,000 firms that were eligible for receiving these incentives, but DDT has only been paid to 1,500, so that's 15% of them, and DLTL has only been paid to 985 firms. The interesting thing is that the firms that do get it are not just random firms that were lucky. The firms that are eligible and get it are much larger than the ones that are eligible and didn't get it. So what this chart shows, the one you have in the screen, is the distribution of the size of firms that are eligible for the drawbacks in orange. And then in blue, the distribution of the size of firms that are eligible and did get it in blue, right? So what you see is that that distribution is to the right, meaning firms that are eligible and get it are larger than those that are eligible and do not get the rebate. So there are a couple of interpretations for this. One is the process of claiming this incentive is complicated, and so the larger the firm, the easier it is to get it because it has an administrative department that can deal with that. The other interpretation, or is a complementary interpretation, is that because there are limited funds allocated for these rebates and the funds are allocated on a first come first serve, then it's the large firms that exhaust. So some large firms are going to claim and exhaust the resources, and then the smaller firms that are going to run slower to get the rebate are not going to have any more funds to actually receive this incentive. So one issue that we can already identify here is that smaller firms struggle to get these rebates, even if they are eligible. And the fact that these rebates are allocated on a first come first serve is problematic. So that is already one element to consider when one thinks about policy implications of the analysis. The firms that do get it are not only larger, they're also more sophisticated. If one looks at, for example, the diversification of their operations, so the beneficiaries of DDT, the beneficiaries of the LTL, when compared to eligible firms but non-beneficiaries, tend to be larger and tend to be more diversified, both in terms of the median number of destinations they reach and the median number of products that they export, both for DDT and the LTL. So larger firms, more diversified, which means basically more sophisticated firms are the ones that manage to navigate the process to get that export incentive paid. So this is on take up. Let me move into the design objectives. So as we were saying before, this is an export promotion scheme. It targets certain products. Certain products are not eligible. So what we wanted to see is that targeting follows which objective? Does it follow an objective of growth? Does it follow an objective of diversification? Does it follow an objective of sophistication or of environmental sustainability? Of none of those. So the first thing that we can say is these two schemes, the one that focuses on textiles, the one that focuses on non-textiles, tend to target products that have a real comparative advantage. For the case of DDT, products in which exporters tend to be larger, but they also target products that have low global demand and destinations that have low export potential for Pakistan. So first thing is that they target products with a real comparative advantage. And for the case of DDT, eligible products are more likely to be exported by larger exporters. So what this chart shows is on the horizontal axis, the average exporter size by product. On the vertical axis, the real comparative advantage of each sector, and each bubble is basically a sector. And in red, you have the eligible sectors. In blue, you have the non-eligible sectors. And what you see is that for the case of DDT that covers textiles, most of the eligible products fall into the top right quadrant. That means sectors that have large exporters and sectors that have a comparative advantage. So what this export promotion scheme is incentivizing is the exports of things that already have a comparative advantage, in which Pakistan already has a comparative advantage, and the export of products in which you have very large exporters. Now, if you look at whether the scheme favors or not products that have high global demand, so high growth in global demand. So products that are dynamic in world markets. So basically what we find is that the schemes do not favor them. So if you look at across the whole universe of products, average import growth, global import growth has been in the last years 5.4%. Import growth for the products that Pakistan exports is 3.4%. For the products that Pakistan doesn't export is 8.6%. So already we can say Pakistan tends to export products in which global demand is relatively low. But if you look at eligible and non-eligible, similar rates of global demand, 3.2 and 3.4. So there's a little bit of a difference, but the difference is not statistically significant. But when you start looking at the different rates that are paid, so the different percentage of the rebate, what we can see is that the highest rate of the rebate, the 4% drawback, targets products that show the lowest global growth in demand. So the targeting is not looking at global demand to identify products. And the interesting thing is also there is an SRO that says that identifies a number of non-traditional destinations to which if exporters reach, then they get an additional 2% in their rebate. Now, let's look at those destinations. So basically what this chart is going to show you is on the horizontal axis, the import growth of Pakistan's trading partners, and in the vertical axis, Pakistan's export potential that is untapped, what we call Pakistan's missing exports, right? So the countries for which the SRO gives an additional rebate are those in red that are basically countries that show low export potential for Pakistani exporters and to some extent low import growth, so low dynamism, yeah? Now, the countries that have high export potential for Pakistan are those in blue in the top quadrants, top right and top left, but those destinations are not targeted by additional rebate. So this is another important result that reveals that the list of non-traditional destinations that is targeted for an additional 2% rebate may benefit from being revised, identifying instead destinations that have high potential for Pakistan. Think about Vietnam, think about Ukraine, think about Philippines, China, Russia, countries that are in that top right quadrant that are high dynamism and high potential for Pakistan. So that's another important result. Let me move to the second message of this analysis that has to do with whether the incentives, these export promotion schemes, work towards diversification. The answer here is quite a robust no. So both schemes, the DLTL and the DDT, have a very marked anti-new pro-incumbent bias. The services sector is completely excluded, but let me give you one indicator on why we're saying that these export promotion schemes have an anti-new bias. There are, if you look at the classification of all export products that Pakistan could be exporting, there are about 7,500 products, 7,531 product varieties that Pakistan could be exporting. Out of those 7,531, Pakistan exports 4,689, right? So it's about 2/3. 2,842 are product varieties that are not exported by Pakistan. Of those products that are exported by Pakistan, there are 1,260 that are eligible for rebates. That is, the targeting rate of existing products, so products that Pakistani exporters are already exporting, is of 27%. 27% of products that Pakistan exports are targeted by these schemes. But the number of products that Pakistan is not exporting, and therefore perhaps policy should push for exporters to get into those products, so that products that are eligible for rebates but are not currently exported by Pakistan are 43. So 43 out of 2,842. So the targeting rate of existing products is 27%. The targeting rate of potentially new products is 1.5%, right? So this scheme is not trying to move firms to produce something new. It is basically supporting firms that are exporting something that has already been exported for a long time. We say that this basically introduces an anti-diversification or an anti-new bias. And it doesn't seem conducive to the promotion of non-established products. So the other thing, and if you look for DDT in particular is the case. So if you look at the products within textiles that are promoted by DDT, what you see is that most of the products promoted fall under the category of products that are well established already. So products that are exported by a large number of exporters and to a large number of destinations. So of those, 77% of those products are actually eligible. But if you look at those products that are not well established, or the bottom left of the chart on the left, those products that are not exported by many exporters and that do not reach many destinations, only 19% are eligible. Something similar, but to a lower extent, happens in DLTL. So what we can say here is basically the schemes exacerbate the existing pattern. So they exacerbate the status quo, right? They do not attempt to promote the diversification of the export bundle. Instead, they support well-established export products. This is, I'm not saying this is a problem. I'm saying that this is an anti-diversification objective. The third message has to do with the sophistication of the export bundle and the extent to which these schemes help firms to move into more sophisticated export products. So just as a way of background, the Pakistan export bundle is relatively unsophisticated. So if you measure sophistication using an indicator of economic complexity, you can see that Pakistan ranks 99 out of 133 countries for which we can compute this index. It is not the worst in the class in South Asia. So the South Asian countries are in red. It's also not the best in the class. So it's somewhere there in the middle, but it's at the bottom of the distribution. Does this export promotion incentive help moving up the quality ladder or the sophistication ladder? Well, it doesn't. Actually, rebates rates are higher for products that show lower levels of sophistication. So what we do here is we calculate an indicator of sophistication of products, and we look at whether the targeted products are more or less sophisticated according to that indicator. What we see is the level of sophistication of the non-eligible products in red in this chart is the highest, and then the level of sophistication for the eligible products is in blue, and in lighter blue is the ones that actually receive the highest drawback rate. So what you see is the scheme pays more of an incentive to those that produce least sophisticated products. So the objective there on trying to make the bundle more sophisticated is not there. Fourth message has to do with environmental sustainability. So the other thing we wanted to check was whether the scheme favors moving into a more environmentally sustainable basket. So we looked at two things: water intensity and energy intensity. On water intensity, there are no clear results, so there's no bias. The incentive favors both in the same way, water intensive and water non-intensive. On energy intensity, there is some evidence in favor of an energy intensive bias. So there is a little bit more of incentives paid to sectors that produce products with that are more at risk of carbon leakage. That is, products that have an associated higher rate of emission of carbon than those that have a lower rate of emission. So these are basically the four main messages. let me summarize before we move into the discussion. So when we look at these two schemes, DDT and DLTL, and we look at who gets it and who doesn't get it, given that they are eligible, what we find is many firms that are eligible do not get it. And those that do get it tend to be large and sophisticated firms. Probably this is because there's a first come, first served system to allocate resources. When one examines the eligibility criteria is not consistent with objectives of diversification in particular, but also not fully conducive to growth. This is because eligible products for rebate face less dynamic global demand because destination premium is targeted towards low potential destinations, and because both schemes have an anti-new product bias. So they are not pushing firms, they are not helping firms to move into new products. Instead, they are rewarding firms for staying with the export basket that they already have. Eligibility criteria is not consistent with increasing the sophistication of products, and it encourages exports of energy-intensive products, but only to a little extent. So that is not a very marked feature. So what we would recommend to make these schemes conducive to improved export performance is, first of all, increase the scope of eligibility of this incentive to include the services sector, but also to include new sectors or new products that are not yet exported by Pakistan, reduce dispersion rates, reduce the average rate, so that this doesn't become a fiscally something that is a large burden, right? But condition 100% of the incentive to growth in exports. So instead of rewarding the level of exports, reward the delta, the growth in exports, and make new exporters automatically eligible. So this is just a few elements that I wanted to throw in the discussion, right? Focus on all products rather than target, and focus on growth rather than on levels. And simplify, digitize, automate so that the claiming process becomes easier for smaller firms. Avoid having first come, first served. And finally, collect systematic data on export performance of recipients and non-recipients so that actually impact evaluation of the schemes can be conducted, and then decisions moving forward on whether these schemes should receive more or less money are taken on the basis of evidence on performance. So I will stop here, and I look forward to the discussion. Thank you.
Thank you very much, Gonzalo. Thank you. All I can say is, why am I not surprised? The government does these haphazard things very fast, very rapidly, presumes to consult people. They tend to be the same old people, and we get the same old mistakes, and we keep doing these econometric exercises. But I guess there's no learning in the government, and there's no learning. Maybe you can reach them, the PID cannot reach them. But this is great. Yes, we know that the eligibility criteria and everything else is befuddled. But I won't take up the floor. Let's go to Ahsan Malik. Ahsan Malik, sir, over to you.
Okay, ji, Assalamualaikum. As always, I think Gonzalo's insight is extremely useful. We couldn't agree, or I couldn't agree more with this outcome. Clearly, the schemes are not well targeted, and there is scope to simplify and digitize and make it easier. And so absolutely no, no difference of opinion there. One of the things that stood out from his presentation was the total amount that has been claimed by the various schemes that are currently available. And if you calculate the average percentage as a percentage of the total exports, I'm talking of total exports, whether they're entitled to rebates or not, that works out to less than 0.5%. And I can tell you, you don't need to have a very scientific way of calculating the total burden of taxation and all the levies. There's significantly more than 0.5%. So clearly, the schemes are not to the extent that they're compensating anybody, they are not compensating what is absolutely required. But before really talking about the schemes per se, I think it would be useful to spend just a few minutes talking about the overall context of competitiveness of Pakistan industry and Pakistan's export. I think it comes as no surprise to anyone to know that Pakistan suffers one of the highest energy costs in the region. Based on, depending on what kind of industry you are and what time of the day you work, etc., etc., the average energy cost on a per kilowatt hour is anywhere between 40 to 60% higher. I'm sure somebody in the audience will be saying, but the five main export sectors do get relatively competitive energy rates, and the answer is yes, they do. However, if you want your exports to increase, you must also be able to allow your domestic industry to gain competitiveness in terms of scale, etc. And clearly, with this kind of energy cost, the domestic industry is not going to gain the competitiveness and be eligible for exports. So that's one. The second one is labor productivity. Notice I'm not talking about labor cost, because labor cost is going to go up as a result of the minimum wage hike that is going to happen as a result of the various competing budgets that have come out, and maybe that's good for the labor. So we're not going to focus on the cost, we're going to focus on the productivity. And if you look at the rate of productivity growth in Pakistan over the last 15-20 years, the average works out to about 30% over the cumulative growth rate is about that, versus about 388% in Bangladesh, doubling in Bangladesh and about 388% in India. Land cost in Pakistan, you want to make stuff on out of factories. Factories are on land. Land cost on a per acre basis, if you're lucky enough to get it where the population happens to live, is significantly higher than the competing land costs in the region. Logistics, I think it's again, no secret that the cost of moving goods in Pakistan is significantly higher. And then, of course, we have the regulatory burden. Although we belong to South Asia, and I would say the whole of South Asia is burdened with the after effects or the legacies of the colonial masters, I think we excel in that, because we found a way of getting our civil servants to focus on the formal sector, all the energy, all the efforts, etc., and left the informal sector out, and that is expressed in terms of the contribution, the tax to GDP ratio, and many other factors. If you then look at what do we export, obviously there's a high concentration and reliance on textiles, and within textiles, as Gonzalo mentioned, and we know that our reliance on the low value added spectrum of textiles is the highest. We also like to focus on the EU and the UK and USA, North America, the more developed world, because we are used to that, but also because generally there's less risk involved in dealing with those countries. And then we tend to ignore Africa and Central Asia, where there is a high growth potential, but it is risky, and we don't have the kind of export credit risk coverage that other countries offer, including India next door. We don't actually have those. So why do you expect a private sector exporter to even look at those countries when they can happily export to the larger retail chains in the EU and so on? And as Gonzalo also pointed out, we basically ignore services, and we think services will just grow by themselves. After all, the world owes this to us, that they should buy software from us and other business services. And lo and behold, when we find that they don't buy as much as they can, then we are sort of somewhat surprised. So we don't actually incentivize services, whether it is through rebates or whether it is through concessional credit, much as we do in terms of what we offer the export of goods. Now, in principle, any export subsidy or export rebate ought to be able to wash the export price totally clean of all the tax levies that one encounters. We've already looked at 0.5% as being the cost. Clearly, the actual cost or the is significantly higher than 0.5%. There are about 70% levy, 70 plus levies that an average Pakistani business encounters, and clearly our rebates are not sufficient to be able to cope with that. The schemes have to be simple. Obviously, they are not simple. Otherwise, more of our exporters would be availing of those. The fact that only larger ones are able to avail of that is because they are able to overcome the regulatory burden. They are able to employ the kind of people that are the army of people that are required to be able to do that. So our SMEs are not able to claim. The more extended the value chain that will be, and in some cases like footwear and other sectors, we have a very extended value chain. Clearly, it is not possible for the rebates that our exporters are able to get is the kind of levies or are based on the levies that they directly encounter. Yeah, when they buy from SMEs who are unable to furnish the documentary proof, they are not able to factor that into their representation. So really, we need to work out a per unit based kind of a rebate as opposed to a percentage of the export value rebate, and it has been done in India and has been done in other countries. So we must be able to, for example, get a per pair of shoe rebate as opposed to a percentage rebate. In India, they have a very sophisticated what they call services export from India scheme that allows rebates of between 3 and 7% on a host of services. There are about 45 different services that they are able to claim, and we need to be able to emulate that. There is definitely scope for automation. The State Bank of Pakistan and the banks have got a very sophisticated direct credit system available, but only if they get the financial ability to give the credit. But it's want of that. So those exist. Gonzalo also mentioned that there is an element in these current schemes which is incentive based. That is not the appropriate way of running an export scheme. The reason why I say that is not appropriate is because if you start at the beginning of the year and you do not know whether you are actually going to get that incentive, because you don't know, the world demand may not exist for your product, you're not going to be able to factor that into your export price. Yes, if you do get it at the end of the year, you will be able to pocket that, and that's great for you, but it's probably not doing any good for the country. And I think last but not the least, Gonzalo very rightly mentioned that we don't do impact analysis. We throw this money, we hope that it will land in the appropriate holes, brackets, pockets and whatever, but we never ever look at the impact. And last but not the least, we do have anti-dumping duties in Pakistan. One of the reasons why our textiles are not growing at the rate that they ought to be growing is because the demand for textiles is now in man-made on apparel which is based on man-made fibers, and we have provided protection to some of our man-made fiber manufacturers who are really reliant on outdated technology, and they're not able to compete with the likes of China and the likes of Korea, the likes of Taiwan. And anti-dumping duty, even an exporter is not able to claim that. So I think I'll just stop at that. And so very broadly speaking, in total agreement with what Gonzalo had to say. Thank you.
Excellent. Okay, thank you very much, Ehsan Sahab. Your points are well taken. But the question is that because we have so many domestic difficulties, because we have huge amounts of, how should I say, administrative costs, costs of regulation, costs of land, all kinds of crazy costs, because the markets are not developed and because you've got regulatory harassment. Because of that, we should go ahead and give subsidies to industry That's been a legacy for the last 70 years. We've been giving subsidies to industries to make up for our defects otherwise. So it's like giving a handicap to a guy who's already, engaged in favoritism. I don't know whether this crony capitalism is a good idea or not, but let's go to Ghulam Qadir sir. Ghulam Qadir sir, aap bataiye.
So thank you very much. It's an absolute honor to be here on this prestigious platform. I think a great study done by Gonzalo. You have correctly pointed out that we need to diversify our exports, and the schemes should be designed as such, and they should incentivize that. Not only that should not only incentivize product diversification, but also geographical diversification as well. I just wanted to, and Ehsan Malik Saab very articulated, the reason why we need these sort of schemes. I would just like to add here that as part of a team at National Tariff Commission, we have created a tariff policy center. And we are working our way around to create a sort of a narrative which could help, make tariff changes acceptable for the policymakers, because there are competing interests, as we all know, and to have this kind of a structural reform going, and obviously they have long-term benefits. So in policy myopia, sometimes you're not able to see the results, and hence we design these kind of schemes. One another reason is since we have done some research, and it has shown that 80% of our exports are affected by our competitors' subsidies, which they give. For example, India, China, and all the other exporters, they dole out huge subsidies to their exporters, and which affect our exporters. We have to give a level playing field. So we need to do something, and one cannot undermine the importance of exports. We need these exports, as we know, the boom and bust that we face, and and the lack of exports has been one of the reasons why we have not been able to have a sustainable growth. And there is a great realization at the Ministry of Commerce, and a lot of work is being done to change this. And in the strategic trade policy framework, as Gonzalo mentioned, that we have limited number of exports. In the upcoming strategic trade policy framework, we have introduced new emerging sectors also, and there's going to be DLTL and such incentives for those sectors, so as to encourage diversification of exports. For example, food, value-added food is one of the key areas where we need to focus, and there are many other ones. Another thing I would like to comment on Mr. Gonzalo's findings. We have also done an export potential indicator study based on ITC's methodology. And what we saw was that major unrealized potential lies in what we are exporting already. We also, in tandem with that, we also did a product diversification indicator as well. It was a huge data-intensive exercise with millions of data rows that we dealt with. But somehow we found that the unrealized potential in the existing sectors was around 4 to 5 billion, whereas the new sectors, that we probably could move towards easily. And obviously there are tech sectors which obviously we can move in the long term, but it's very difficult to move towards them in the short run. So we got to keep that factor in mind as well, because we think that what do you say, easy winners would be those sectors which are already big. Another point is the SME anti-SME bias. I totally agree with that. Their total number of exporters is much more, and the firms that are utilizing these schemes, it is much lesser. Well, in the case of DLTL, it's still higher, but if you look at it, the export facilitation schemes done by customs, the DTRE and the bonded warehouse and export-oriented units, there the utilization is only 4 to 6%. So here in this center, Tariff Policy Center, we looked at international best practices also. We saw in India, there was a separate directorate called Directorate General of Foreign Trade. And their primary objective is to increase the number of firms who utilize these schemes. You know, we got a sorry figure that we have only 4 to 5 or 10% of the exporter using these schemes, and it should be more than 80 to 90%, and Bangladesh is doing that. So, and their objective is to increase. So in this strategic trade policy framework, the government has included, has kept as one of its targets to increase the number of exporters who utilize these schemes every year. So currently, if it's 5 to 6%, it's going to increase to 15%, 25%, and hopefully, by 2025, we could have like 50% of exporters using that. And I think that can become, could be a revolutionary step as well. Totally agree with your findings overall. There are regulatory issues and all of that. I would just like to inform the audience also that under the tariff policy, national tariff policy, in the last 2 to 3 years, our trade weighted average tariff has fallen from 9% to 7%. And I must tell you that this is a great reform in the offing, and this has recently resulted and helped increasing the imports of raw materials by 25 to 30%. And it is probably one of the factors which is contributing to the surprise GDP growth element in the country as well. Where such distortive things are sort of a need of the hour, you have to keep them going. But structural policies and structural interventions are also taking place, and we're working towards that, and we're trying to create a narrative so that to make those structural policy interventions more acceptable, palatable for the government. So, if you move in tandem, you improve the efficiency of these schemes, as Mr. Gonzalo and Mr. Ihsan mentioned, and plus you keep on doing the, so you're narrowing it down, and you're probably getting to, looking to sustain the sort of export sort of growth that we are seeing these days because of higher LSM, and we're seeing an economic recovery and all of that. So thank you very much for the invitation, and I look forward to answer any questions. Thank you.
Thank you, Qadir Sahab. I don't know whether I'm living in a command economy, whether this is a market-driven economy. I'd like the panel to respond to this question. Is it the government's job to sector pick? Is it the government's job to pick which goods are going to be exported, which goods are not going to be exported? Gonzalo, I remember Milton Friedman telling me, if you are so smart that you can pick goods that can be exported or traded, go out and make money. Don't sit here and advise governments. So are we doing that too much? The second question that I'd like to raise is, yes, this issue of competitive subsidy, that India is giving a subsidy, so-and-so is giving a subsidy, so I should give a subsidy too. So some kid is getting more, tuition, I should give my kid more tuition too. I find that very bizarre. If I remember right, again, Gonzalo, please remind us, and Murtaza Saab and Qadir Saab, you will also probably remind us. There was a small lesson in Economics 101, which used to be a standard exam question, that subsidies are just a way of keeping the exchange rate at a certain level. If we think there is a subsidy, why don't we just give a 10% more devaluation? Will that not work? So two questions to the panel. One is, are we in a command economy? Is the government so clever that it can pick? Does it have all the information that it can sector pick, it can good pick? And why are we not taking straight devaluations rather than a subsidy as an option? Gonzalo, you first.
Thank you, Nadim. So I think you raised probably the most important question, right? So I'll be brief on this, but this goes to the nature of the schemes, right? So if the nature of the scheme is to be a duty drawback, right? So to refund exporters for duties paid. And I think Esan Saab mentioned this, right? So if we want to give exporters, compensate exporters for whatever taxes they have to pay domestically, so they can go to international markets on an equal footing with others, then these schemes should not target one product and one product yes, one product no, right? So the targeting should be removed from this, and then because all exporters pay some sort of taxes, so it's not that some exporters of men's suits pay the tax, but of women's suits don't, right? And what these schemes do is they target very specific products and they leave out very, very specific products. So in that sense, I think that there should be no targeting, right? So all products should be eligible if what we are doing is somehow compensating exporters for extra charges that they face in the domestic market. I'm not saying whether I agree with that or not, but if that is the purpose, I think that's the way it should be done. Now, into what to choose and what not to choose, what I do think is that if instead what we're trying to do is what it seems to be the objective of these schemes, that is promote exports rather than compensating and having a duty drawback. So if what we're doing is something else, so if this is a trade enhancement scheme, then what I would do if I was a policymaker is I would encourage diversification and sophistication, because I consider these to be objectives that are aligned with further growth down the road. And so I would not put my dollars, scarce dollars that I'm taking from other uses, I would not put them in supporting firms that have been exporting the same thing for a long time, because these firms probably, if I remove the subsidy from them, they will continue exporting. So I'm not inducing any new behavior. So if I do want to induce some new behavior, then I would foster diversification, that is, select products that are new to the export basket of Pakistan, select products that are more sophisticated. I wouldn't pick and choose, but to some extent there is some picking and choosing. There is new products and more sophisticated products. Then you ask this question of the equivalence between subsidy and exchange rate depreciation. So I think that's a complex question. I will try to avoid it. But what I can say is that the relative appreciation of exchange rate, to some extent artificial for many years in Pakistan, hurt the export sector quite a lot. And we have evidence on that. The export sector needs a competitive exchange rate to function efficiently. But I think this goes to a little bit more of a more complicated situation. That is, and I hear this a lot here in Pakistan, that is, because there are problems with labor productivity or with the regulatory environment or with doing business costs and et cetera, then we need to give exporters or firms in general subsidies. So perhaps the public policy should address the main problem, that is the cost of doing business, that is the labor productivity challenge and the skill agenda, rather than focusing on these patches, right? So that would be my point. So those are my 2 cents on this. Oh.
Gonzalo, I don't mean to put you on the spot, and I appreciate what you're saying. I agree with you that the main issue to be addressed, as I've said often enough, is the civil service reform, is the governance reform, which you don't want to do. Okay, fair enough. But then, like everything in life, you don't want to do something. I don't want to lose weight. I have to take the risk of having some health problem, right? Simple. There is no free lunch in the world. Would you agree? If that is the case, then all I'm saying is we don't want to address our cost issue, our inefficiency issue, our productivity issue, right? Instead, we want to subsidize it away. Is that policy, all I'm saying is exactly substitutable with an exchange rate change policy. And I'm asking you a theoretical question, not about Pakistan. Very simple. If you have a cost issue because of your inefficiency, like I have a fat problem because of my stupidity, I have to pay the price somewhere. So the question is it okay to allow devaluation, or is it first best is to allow subsidies?
Well, no, so they are not equivalent, right? So they are not equivalent because the subsidy targets specific products, whereas the devaluation is across the board. The evaluation will affect, so will benefit those that have more value added as a share of output, will benefit less those that use a lot of imported inputs, right? But also the evaluation also has other implications, right? So the evaluation is not, what I mentioned is the evaluation is good for exporters, but the evaluation has impact on public finance because it increases the burden of public debt that is denominated in dollars on fiscal accounts. The evaluation has impact on inflation rates, and it has impact on food prices and therefore on the poor, et cetera, et cetera, et cetera. So there are a number of things that the government needs to take into consideration, or the central bank, when allowing. What I understand, though, however, is that there is a competitive exchange rate regime. So we're not talking about the evaluations here. We're talking about whether what happens if the currency depreciates, right? But I would say they are not equivalent.
Okay, Hassan Saab, tell me, does the government have the capacity to tell you industrialists what to do and when to do? If that is the case, then why does the government own the industry?
Okay, so I believe that the role of the government is not to tell us what to do and what not to do. Much as they may try, nobody's going to listen to that anyway. I think there are two types of policies, broadly speaking. There are the horizontal policies and there are vertical policies. Now, the sad fact is that Pakistan actually doesn't have an industrial policy. But if Pakistan had an industrial policy of which the export policy would be a subset of, it would need to be addressing the horizontal conditions that would impact everyone in industry almost equally, and then vertical ones which would be targeting the specifics. Coming back to the export promotion schemes, I think you can divide the impact, or not the impact, the structure of that into three parts. One is compensating for the taxes that have been suffered, the 70 plus taxes that, as Gonzalo said, everybody pays. It's not just the exporters, and it's not just the exporters of boys knitwear or girls apparel. It is all types of apparel. It's everybody, right? So that's one component of that. The second component obviously is to be competitive with the eyeball competitors that you have, the ones from Bangladesh, from India, from China, and indeed from Vietnam and some of the other countries. Right? And of course, there's the third element, which is hardly ever spoken of, which is trying to compensate for the uncompetitiveness that exists within our overall industrial environment, as a result of which we've seen the role of manufacturing decline over the years. So we've got premature deindustrialization happening in the country, and the things that I mentioned, things like energy costs, land costs, labor productivity, logistics costs, etc., etc. So really, the subsidies or the schemes are really meant to be compensating for those three kinds of elements at the end of the day. It's just that in order to comply with the WTO and other multilateral requirements, we don't ever try and break that down, because then that's where the challenge will start coming in. Yeah. So to answer your question, Nadeem, I don't believe even if the government said we will give you this and we'll give you that, and go and set up an industry to get into an area where either Pakistan lacks a competitive advantage or doesn't have the competence, etc. I don't think you'll find many private sector people rushing towards that. Equally, I think why are the current exporters continuing to do what they are very comfortable with, is because they're very comfortable with that, right? So it's comfortable to go to United States and to the EU. And by the way, one of the things that maybe in the long term is probably not helpful to Pakistan is GSP plus. I know that people will have contrary views here, and people will say GSP Plus is actually a great boon for Pakistan. But the fact is, it provides that subsidy indirectly, which is probably not conducive to long-term competitiveness of Pakistan industry. So I think private sector will go where it feels comfortable. It may be guided by the government, but it will certainly not follow everything that the government wants you to do.
Kadir Saab, your views. Why are you making this big matrix of sectors and goods? Why are you trying to pick goods for the private sector? Does the National Tariff Commission know which goods to subsidize, which not to subsidize? And why do you think that you need to subsidize chosen industries? Why don't you keep a clean, simple tariff policy and a clean, simple exchange rate policy? That is the received wisdom through centuries of experience. Why are we complicating things for ourselves, especially when we don't have the capacity to do anything? Kadir Saab.
So thank you very much, sir. So I think this is where Pide and yourself and all the researchers and the economists, we come into play because it's not easy. You see, our chairperson is fighting day in and day out to get those tariff policy reforms done, but there are competing interests and revenue considerations and all of that. So this year we're probably getting 42 billion rupees of tariff incentives under the national tariff policy, but it was fought hard. And government, and we need to get into these micro issues where we should get into we should be doing more research on the SROs and the fifth schedule and the tariff simplification and the local content requirement, which is there and which is a reality. But in order to get rid of that, we need the government to see that there's going to be benefit from that, and in the short run, and how we project those benefits, that is very important. So your research, Pide's research on RSET, regionally competitive energy tariffs, it was a great job, and it's resonating in government offices, and it is showing some sort of an impact. The government is holding on to that 9 cents energy tariff. It is getting difficult for them, but they know that it's going to be advantageous. So I know for sure that these distortions, they are going to create distortion. It's not going to be good for the economy. As economists, we believe that. They are distortionary, but however, at the same time, this reaching that perfect thing is going to happen in the medium to long term, where we have to set the narrative right, we have to show the empirical results, and we have to improve that. So this is where we need to join hands together. World Bank is doing a great job. I think Gonzalo has done many researches, and we have learned so much from him about anti-export bias. Recently we met some exporters and who were complaining that their product has been, their protection has finished under this budget. So I asked them, what will happen now? So they were saying that the prices are going to go down in the market. Okay, then I said, okay, so then why don't you start looking and start exporting that product abroad, where you could get better prices. So that sort of anti-export bias that we have, which is inherent, and because of the traditional structures that we have, we really need to get rid of them. But how to get rid of them? We need to build a nice empirical narrative so that it happens.
Thank you very much. Thank you very much. Let me go to the floor. Mr. Dawood Pirzada, please introduce yourself and ask your question.
Thank you very much, sir. My name is Mohammad Dawood Pirzada. I work in Federal Board of Revenue, and interestingly also in export policy section. And my views kindly may please be taken as an official version, but my personal observation, starting from the study shared by Mr. Gonzalo, I would like to say that his study is based on just one component of export promotion schemes that is being administered by the Ministry of Commerce, and that is called DTL or DDG. And it's a very small component of support given to the export industry. And to inform the participants and to just refer to the comments of Mr. Hassan Malik, that the support given under the DTL is less than the 1% of the total exports. Let me briefly share with you some few information that which already Ghulam Qadir Saab also shared, that presently there are 4 schemes, export promotion schemes, which are being run by the Federal Board of Revenue. Under these schemes, Federal Board of Revenue, I would not say that is the government of Pakistan, allowed duty and taxes free import of inputs by the exporters who use these 4 schemes, and the value of taxes and duties foregone is close to 50 billion rupees. So you can see that under these 4 schemes, the benefit of 50 billion rupees were given to the exporters who use these schemes. Coming to the fact which was shared by Ghulam Qadir Saab, that only 4 to 5% of the exporters are using these schemes. Let me share with you that around 6% of the exporters are sharing this, using these 4 schemes. But interestingly, you will be surprised to know that these 6% of the users of these schemes account for more than 35% of the total exports of Pakistan. Coming to the very argument, another argument which was also shared by Mr. Gonzalo and Mr. Hassan Malik, that exporters have to be refunded all the duty and taxes which they have paid on the imports. Government of Pakistan has several schemes. Just told you that is the DTL and these 4 export promotion schemes, and all the exporters also get the refund of the sales tax once they are making exports, and the refunds of sales tax amount to close to 200 billion rupees annually around for these exporters. And there is another which I would appreciate if Mr. Gonzalo knows about that. That is about the duty drawbacks that are more than the DTL and DTT shared by Mr. Gonzalo. And the amount of duty drawback that was given in last year was more than 30 billion rupees. And during the current year, the amount of duty drawback given by the Federal Board of Revenue is close to more than 20 billion rupees. Coming to the payment of duty drawback rates, these days we have introduced at FBR a completely automated payment system of duty drawbacks, where the controls by the customs are very nominal. And once the export is effected and the foreign exchange is realized, the available duty drawback is directly credited in the account of the exporter. At the same time, let me also share with you that, as has been discussed, that there are several export promotion schemes. Federal Board of Revenue from the next year is announcing a simple unified single export facilitation scheme that will do away with the existing 3 or 4 schemes that will be phased in next 2 years. And the idea of the single scheme is the complete automation, less control by the regulators, and the focus is that most of the exporters which are not presently using the existing schemes will utilize this new scheme which will be rolled out in coming few months. So as far as my observation is concerned, as regards Nadeem Saab's observation that he was referring to the subsidies, my humble submission is that these are not subsidies. I would straightforward say these are the refunds and duty drawback of the taxes which the exporters has paid on their raw materials and inputs. And I agree with Ghulam Qadir Saab that we are not supporting industry to the extent which our competitors are supporting the industry. But things have to be improved, and we believe that with greater automation and simplification of rules and less controls, we will be able to accommodate many exporters in utilizing these schemes, and particularly the new export facilitation scheme, which will be announced in few minutes. Thank you very much for patient listening.
Thank you,
Nadeem,
Mr.
could I get a word edgeways here?
Ji, please go ahead.
Ji, So, Prasad Sahab, I think first of all, the steps that the FBR is taking to automate and to simplify, I think they have to be welcomed. Yeah. I just want to pick on one issue or one aspect of what you just mentioned. You mentioned that billions of rupees worth of import duty on raw materials that exporters import to convert into export items are refunded or not charged in the first place, and that sales tax is not charged on exports, etc. I mean, I don't think that any country charges sales tax when they export. And I doubt very much if any country in the world levies import duty on the inputs that contribute to the exportable items. It's almost like saying, what I believe some people have been saying, that if in the budget that has just been approved, a tax war had been levied on internet, 100 billion rupees would have been raised, and so the FBR or the budget makers have given away that 100 billion, which actually never would have come to them probably anyway. Yeah, the reason why I'm mentioning that is because this is all to do with the mindset. Often, when you set these schemes, etc., you always look at what you could have charged if the same item had been sold in the domestic market. Yes, you would have charged the import duty on the raw materials, intermediate items, you would have charged sales tax, etc. But we are not talking about selling in the local market. We are talking about selling in the export market, where you need to be competitive, and where I think you have to find a way, and a simpler way, much as you've done in other aspects, to wash the exports clean of all types of levies, all the 70 plus taxes that a business encounters.
Nadeem Saab, if you allow me just for 1 minute to respond this one. Sir, I 100% agree with Malik Saab. I didn't mean in any way that exporters need to be charged for the taxes. And there is no such feeling or understanding in the government or in the FBR that they have to be charged taxes and we are doing any favor to the exporters. Let me clear on behalf of my organization as well, this is not the case. But I mean to say that we are moving towards a scenario through these simplified export promotion schemes that there is no need of the exporters paying taxes at the first instance, and so that there is no question of refunds or duty drawbacks at a later stage. So we have a complete understanding. We agree with your argument that there is no need for taxes on the import of raw materials or inputs or utilities being used by the exporters, because finished goods for exports are not to be taxed at all. So this is a fair understanding, and this is the policy of the government, and we go with that, and there is no second opinion about that.
Thank you very much. Tariq Mahmood Saab. Tariq Mahmood Saab.
Assalamu alaikum, Tariq baat kar raha hu. I am Tariq from Independent Economist. I am 100% agree with Sir Nadeem that the reason to provide export subsidy back in 2017 are overvalued exchange rate in Pakistan, high average applied tariff rates, and high energy cost. Now in 2021, if these issues have been resolved, whether in current form, this is required. I am saying about DLT or DTT. Is this scheme required, or it is a fiscal burden on consumer side? Second, as Dr. Osama Malik Saab mentioned, that we must do an impact analysis for export subsidies. But if exporter received a backlog of 2010, their bonuses or incentives in 2020, then what one can calculate the impact of impact analysis of any scheme that is introduced in 2018 or 17 or in 19. And the last and third question from Mr. Qadir Saab, if average applied tariff rate is now 7%, but if you calculate the RDs and ACDs that are skyrocketing, when I was in National Tariff Commission in 2017-18, the RDs were almost on 600 to 700 products. Now almost 1,000 products are being RD imposed, and ACD at that time was 1% on all products or 2%. Now it has been increased by 7% on finished and intermediate goods. Whether these duty collection have been increased on import stage are decreased. Thank you, sir.
Thank you very much. I'd like to call on Qasim Niaz, former chairman of the Federal Tariff Commission, former trade commissioner, many things. Qasim Niaz has a long career in this area. Qasim, I see you. Can you please tell us what you think of this whole effort? And you spent your lifetime doing this. Can you tell us how we can fix this situation? Qasim, are you there?
Please unmute yourself, sir.
I guess Qasim doesn't want to speak. Okay, Qasim, thanks. Challenge, I'll go back to the panel if there's nobody else. G, go ahead. Can we have Ghulam Qadir Saab? You want to respond to the questions first?
Thank you. Yes, Tariq is right. There has been plethora of RDs and ACDs which had been applied over the years. One issue was that we were in the midst of a balance of payments crisis, and exports had shot up to 60 billion plus. So this was the, and even WTO and, when because of your essential imports surge, you get into balance of payments crisis, you're allowed to charge some sort of tariffs. And we did that, and rightly or wrongly, that's another debate, but it was there. But you said that it was placed earlier on in 2017, 18, 19 as well, through mini budget as well. I mentioned earlier that the CDs were the effective CDs were reduced from 9 to 7. So if you look at it, include ACDs and RDs, so it was 13%. Now it has come down to 10%. So there's a movement, very positive movement in that also. ACDs have been removed on most of the raw material. I know Gonzalo would say that it is going to have a cascading impact, and it's going to, create an anti-export bias. And he has a point. Everybody has a point in that. But since we are moving and gradually moving towards that, so we're currently trying to make intermediates and raw materials more, reduce duties on them so that they could be accessed very easily. Capital goods as well. So this is being done, and according to in the national tariff policy, we hope that this reform would continue and it will bear results soon as well. One comment on exchange rate. So there was some discussion on DLTL. By the way, sir, DLTL and these export facilitation schemes run by customs, they are different. Because, and like Mr. Dawood Pizado mentioned very rightly that, these are the duties and taxes which are due on exporters, but you give them certain time under the bonded warehouse, or you give them certain exemptions, and so that, and because obviously you're not going to export your taxes. So this is one incentive. It's prevalent everywhere. And I mentioned earlier that there's a Directorate General of Foreign Trade in India, which actually supports that. And it acts like a big custom agent, which helps those firms which are not able to utilize these schemes to get to utilize them. So that's why their utilization rate in Bangladesh and India, it's very high compared to Pakistan. And he corrected me. I said 4%. He said 6%. So yes, only a handful of people are using those. And as far as exchange rate is concerned, when in keeping in consideration DLTL and exchange rate, one drawback that it has, which Gonzalo mentioned, many others, but one is that it makes your raw material very expensive. So once your raw material gets very expensive, exporters get a lot of, they get into another quagmire, and they have to pay for it. They get into that liquidity trap again. So overall, all these structural reforms have to be done. But, like I said, we have to follow the pace, and it has to be done in medium term. Thank you.
Thank you. Thank you, Qadir Saab. Hassan Malik Saab, how would you react to the questions and the commentary so far?
Okay, so I just want to respond to the part of the question that Tariq asked about is there a need to continue if things are all falling into the right places? I think the answer is very clearly yes. We need to continue because there is if you take all the cumulative schemes that are currently available to exporters, the combined effect of that does not negate the uncompetitive environment in which industry in general operates in Pakistan. So yes, not only do we need these schemes, we actually need better schemes and better targeted schemes, and so on. I won't repeat why we are uncompetitive. I think that has already been mentioned. Thank you.
Thank you. Gonzalo, can you also tell me why are exporters' policies favor children? Any reason? Should they be treated differently from others?
So the first thing I want to say is I want to make a comment on something that Mr. Dawood from FPR mentioned. So whether these are subsidies or just payment back for duties paid, and it refers to what you're saying, Nadeem. So many firms pay duties, like people pay taxes, right? So everybody is a taxpayer in one way or another. Not everybody gets those taxes refunded. So the fact that these schemes, the DDT and the DLTL, target certain products and certain products are not targeted, and the fact that certain destinations reached are specially rewarded and certain destinations are not rewarded, tells us that this is not just a refund of taxes. This is an export subsidy that has certain objectives and is trying to reallocate resources into certain products and not into other products. So this is the first point I want to make. Now, the second point I want to make, and that goes to the question you're asking, Nadeem, is are exporters any different? And then I would say there are reasons why we may want to encourage exporting. And we may want to encourage exporting because exports not only bring foreign exchange, but also exports are an important platform for productivity growth. So if that is true, and we know that countries that grow faster are countries that ground their growth in productivity growth, then perhaps it makes sense to have a system of incentives that push firms into export markets. So I am completely in agreement with that story. What I do not think is that these schemes do that. So I don't think these schemes are conducive to that. I think what these schemes do is they just reward certain exporters that probably have had the ability to lobby for higher rebate rates, but they do not necessarily encourage firms that are on the verge of, they are selling domestically, but with a little bit of a push, they would move into export markets. I don't think these schemes are doing that job. So I do think exporters are different. They are different because exporting is a platform for productivity growth, and productivity is a good thing. I do think it makes sense in many cases to encourage exporting, but I do not think that this way in which these schemes are designed are conducive to that. Okay.
Well, let me just say, Gonzalo, that my reading of Adam Smith is that he spoke against mercantilism in Europe. And mercantilism in Europe was all about exporting to collect gold. They wanted to export to collect gold, with the result they had children working to export gold. To get gold, they had housewives working to export gold, to get gold, and they ruined the economies and virtually created the French Revolution. Remember Colbert's reforms, etc., etc. Now, my question to you is, Adam Smith said that it is natural for us to export. We don't need incentives to export. I don't need incentives to export. I export my labor every day. I don't need incentives to export. You export your labor. You don't need incentives to export. What is this nonsense that, hey, we must treat these people like children and they bring productivity? No, we all are productive for our own good and we have to be productive. My second question, Gonzalo, you face this question. My second question, why are you preaching against Adam Smith? That's the first question. Why are you preaching mercantilism here? My second question, Gonzalo, can't let you go off lightly. My second question is, Gonzalo, you are a very high-priced resource. I know how much a World Bank economist costs. You cost about $500,000 a year, right? I mean, that's the standard rule that we use in the fund in the bank. Now, you are spending that $500,000 doing this work that anybody in PID or anybody else in a university could do. Now, the World Bank swears to capacity building, yet we don't have the capacity to do this work ourselves. And we have a World Bank economist doing it. Maybe 20 years from now, there'll be another Gonzalo doing it. We will have gone further back and we will not be able to do anything. We'll still be sitting there twiddling with exports and matrices and this, that, etc. When is the World Bank going to build capacity? When are we going to do this work ourselves? Because we can do it far cheaper than you. So two questions. One is you're preaching mercantilism. Two is that World Bank is an expensive resource to do this work. Why can't our local people do it? Go ahead.
Okay, so first of all, no, I'm not a mercantilist. And I do not think you're getting my point on exporting. So I would be a mercantilist if I told you, you need to save all your dollars and accumulate dollars. And to accumulate dollars, you need to export at all costs and stop importing. That would be a mercantilist argument. That's not my argument at all. What I do think is if the objective is economic growth and the objective is to pay better salaries to Pakistani people so that you have more households that get out of poverty, then what you want is productivity growth. That's the crucial element. You need households, people and firms to be more productive so they get better wages. And that is the objective, to grow more productive. To grow more productive, we know that trade is crucial, exporting is crucial, importing is also crucial. Not only exporting, also importing, and importing to export. Attracting foreign direct investment is also crucial. All of these things are part of a package that is conducive to productivity growth. My objective, or the way I think about this, the objective for the policymaker, for public policy, should be to boost productivity. I think that exporting is a platform for that. Importing is also a platform. Attracting foreign investment is also a platform. So this is not about mercantilism. And you're saying, Adam Smith says that exporting is a natural phenomenon. It may be a natural phenomenon in the absence of distortions, but in Pakistan, you have a tariff policy that gives such high levels of protection to sell domestically that it is very difficult for firms to choose to export if they can't sell domestically. And I don't know in which part of Islamabad you are, but I invite you to go to any of these shops that sell cheese. I see a lot in social media saying, the only case of import substitution that worked in Pakistan was for cheese. So go and find Pakistani cheese. Very nice. I eat it quite frequently. But it costs $8, right? So how come is it so expensive? So what I did was I checked the tariff schedule. So tariffs on cheese are about 50%. That means that the producer of cheese in Pakistan that is selling at $8 in Kosar market will never go and export this cheese because it has such a big captive market in Pakistan with that high tariff that it has absolutely no incentive. So it would be natural for firms to go and export in the absence of a tariff policy that creates an anti-export bias. But you do have a tariff policy that creates an anti-export bias. So this is, in a way, it's a little bit like the doing business problem. So you have a complicated doing business environment. So you need to incentivize firms to compensate them to some extent. Of course, if you sort out the anti-export bias problem of your tariff policy, then perhaps you don't need these incentives to export anymore. So that's one thing. And then on the capacity building, so I think you're asking me this question. Perhaps that question is a question you should ask the government of Pakistan. However, let me tell you this. The way we operate, and particularly, and I can say the way I lead the trade program of the World Bank in Pakistan. And since I have been here, one of the things I have taken to heart is to actually interact with the researchers in Ministry of Commerce and National Tariff Commission. And we have a capacity building program particularly active with National Tariff Commission, because National Tariff Commission has been much more receptive to it. And what I've been trying to do, and what my team has been trying to do, is to work together with these researchers in National Tariff Commission, in Ministry of Commerce, so that this type of analysis that we do gradually is brought, it can be done in-house by those teams. So I do think that capacity building is crucial. And I hope that by the time my tenure is over here, there are many talented trade economists. I mean, you know, you have some in the panel, you have some that were asking questions. So I think that capacity building process is ongoing.
Thank you, Gonzalo. Thank you very much.
Let me say one more thing. We want that capacity, we want to bring Pide into this capacity building program. And in fact, let me remind you that we want to build a CGE model for trade, and you know, in which commerce, NTC, and Pide are all part of the game, so that you know we don't do that, you do that. Over.
Thank you, Gonzalo. Thank you very much. I remember when I was in the fund, I wrote a number of papers on the brain drain, and I think the brain drain is something that we also have to think about in the same way as exports. For example, we think of improving our productivity by increasing our exports while also exporting our brain. So I think there's a bit of a problem there. We train somebody and immediately he goes outside. Why? Because we can't keep the person here. So a number of distortions we have to talk about, a number of things we have to talk about. I think quite frankly, we can't talk about exports in isolation. And what I call mercantilism is treating exports in isolation. It's the same approach that, who was it before Adam Smith, who, I forget the name now, the mercantilists, whoever they were talking about that. Get gold no matter what. Put your children to work. Sell your women. Get gold. That's the same approach we've got now. Export, export, export. Jesus, we've exported. For example, I remember, very interesting, Gonzalo, before your time, there was a famous writer called Khalid Hassan. He died. Very good writer, very well-known writer. Everybody knew him. He wrote an article and then a book which said, give us back our onions. He said, guys, you're taking all our best onions away. And what are we getting? Paper money in the bargain? The US also has done this. It has had an export declining economy over the last 40 years and has done very well. US trade deficit has been huge over the last 40 years. So I think we need to revise these things, but there is no shortcut to having your domestic state in order. And we are paying a price only because we refuse to give up colonialism, because we've clutched colonialism to our heart. And here, unfortunately, the multilateral donors are also helping us clutch colonialism to the core. Nobody wants to reform colonialism. We stay with a colonial judiciary, a colonial bureaucracy, a colonial everything, a colonial legal system. And to compensate that, we give subsidies, we give all kinds of things. To compensate that, we put in tariffs, protection, this, that, etc. All these policies are not working. And this is not today. PID documented this in the 1960s, 70s. And the position remains the same. Our universities have no say in the matter. So we'll rely on you, Gonzalo, to help us get over this hump. When, I don't know. Let's hope it'll happen soon. Thank you very much, folks. We've had a wonderful webinar. We'll do it again, inshallah. Thank you. Bye-bye.